we, do ventures with people, how we invest. Ultimately, those are all business decisions. And I wish that there was like one sort of simple accounting guideline to say this is how you report for everything, but it's a little bit more complicated than that. Okay, we've got a lot of different stuff that goes back. So there was a statement of position, SOP 78, that gave us some guidance on this, but you ultimately need to go back. So the principles of consolidation ultimately, they predate me, Noah. They actually go back to 1968, okay? The accounting research bulletins, so ARB 51 basically codifies the principles, or the underlying principles of consolidation. And what the accounting research bulletin tells us, so this just the ARBs were an amalgamation of like general wisdom and things that people had passed down through the ages, right? But basically, what ARB tells us is that all entities, listen to the following, all entities in which a parent has a controlling financial interest through direct or indirect ownership shall be consolidated. Any parent which has a controlling financial interest through direct or indirect ownership of a majority voting interest shall be consolidated. So what this is basically saying, looking at the chart, right? If company A has a direct or indirect financial controlling interest, it must consolidate the entity. Now, they say, what does consolidation mean? I'm going to tell you that. But if you have direct or indirect financial control, and we can read voting into this, okay, you must consolidate that entity. Now, we're really going to talk about three different layers here of three different thresholds, okay? So we're going to talk about a layer which is anything greater than 50%, and we're going to call that consolidation. Okay? We're going to talk about a layer that is greater than 20%, but obviously less than 50%, and we're going to call that the equity basis of accounting.
Equity basis of accounting.
Equity basis of accounting. And obviously, by default, anything less than 20%, we're going to call the cost basis of accounting. Okay? So, when we talk about ARB 51 saying that any subsidiary of a company in which the parent has direct or indirect voting financial control, we're talking about any entity in which the parent participates more than 50%. That's the threshold. Now, last week we talked in taxation, and what did we say that a company needed to own in a subsidiary in order to consolidate for tax purposes? 80%.
So, if you have Prudential involved and you have someone who declared 5% interest,
how much?
A 5% or greater interest in Prudential shares, would they then have to?
Well, so you're saying, does somebody own 5% of Prudential? Is that what you're saying?
Well, not in this case, but if someone owns 5% of the publicly traded entity and they file, do they then have to be considered a controlling interest in if they're holding the 90% equity, even though it's a dilution of 90 and 5?
No.
You get what I'm saying, right?
Yeah, I mean, you're complicating this far beyond what we need to. So, a guy who has 5% interest in Prudential is going to report on a cost basis of accounting, and so he doesn't have to do anything on what you just said. Now, the guy owned more than 50% of Prudential, and Prudential owned more than 90% in a project, then we can start talking, okay? But we're not there, okay? We're not there yet. Let's go through basics first, okay? So basically, ARB 51 tells us that somebody who has direct control must consolidate. Now, why would somebody want to consolidate, or why would someone not want to consolidate? mean, if I owned a bunch of subsidiaries, I think I'd want to consolidate, right? Or not?
So you say we'll consolidate now.
It means I need to do a line-by-line summation of my balance sheet and my income
Yeah, 'cause you can
statement.
write off losses
I have to
here.
show, I have to show to the public the totality of my transactions.
Oh,
So like Alphabet, right? With
Okay,
Google,
so Alphabet, I don't know how their structure is, but Alphabet is a holding company that owns a company called Google, right? Okay, so Alphabet's financial statements include the totality of the balance sheet. So their balance sheet is basically, so consolidation is basically this, okay? So you get company A, company B, company C, okay? Company A owns A and B and C, right? Let's just make it simple and say they own 100% of each, okay? So when you do the balance sheet, you basically go cash, accounts receivable, and so on down the line, and you start putting numbers, right? So the consolidated statements of A is the summation of all of these companies, okay? There used to be something called pooling of interest. You don't do that anymore. This textbook talked about something called a pro rata consolidation. Never seen that anywhere, never seen that in any literature, never seen that worked anywhere. So if you have more than 50%, you have an obligation to do a line-by-line summation. Now, the question comes up, well, what happens with the other percent that you don't own, right? Well, you need to create a little line item which sits between liabilities and equity, which you call minority interest. Okay? And you essentially account for the portion that you don't own by creating this minority interest component. Yes, Stephen?
No, say there's a third company, or a fourth company, company D, and they were 40%.
Okay, so you're going to do the equity basis of accounting, and we're going to get to that. I'm going to tell you how you do that in a second, okay?
But you wouldn't consolidate D.
You don't do line by line.
Gotcha.
Say, so what's going to happen is in your balance sheet, you're going to have an account called investments in unconsolidated subsidiaries. Fun facts that you always wanted to know, right? Ben, don't laugh, dude.
wasn't that on like on the 10Ks that we?
It was.
I remember that.
You
I
see?
remember unconsolidated.
You see, I mean, it all sort of comes together at a certain point, right? So basically, I'm going to say a big mouthful, okay? So, say a big mouthful. So, using the equity basis of accounting is essentially doing a one-line consolidation. And you say, well, how do you do that? I'll explain that in a second. But it's like a one-line consolidation, okay? Now, going back to, it seems to me that most people would want to consolidate their financial statements. But the reality is a lot of people don't, because they want to hide losses or debt in certain companies, okay? And going back to Enron, things, shenanigans that they created, they were looking for legal forms to obviate the substance of their ownership in a company, okay? And so basically, what you know, the ARBs tell us, what accounting law tells us is you control it, you got to report it, you got to include it, because a reader cannot really see what the totality of the financial results of a company are, okay, until you see the consolidated law. In a very strict sense, you can do parent company only financial statements. So you can issue a set of financial statements for only the holding company. But in a strict sense, that's not GAAP, because GAAP would require you to only present company A and consolidated subsidiaries. Okay, so you can present standalone company financials, but GAAP is consolidated. Okay, if you've got anything that you can consolidate, you can consolidate. Now, in addition to consolidating wholly owned subsidiaries, I want to introduce a concept. I've talked about Enron. So, in a strict sense, as accountants, if we always followed substance over form, we would have never had a problem with Enron. So what Enron did was, Enron created something that had a funky name called VIE, Variable Interest Entity. And so the accounting literature now defined the variable interest entity, okay? So a VIE, so they created a bunch of VIE. So what they basically said was, so this was Enron, right? So Enron had all these subsidiaries. Well, like when they wanted to like borrow money, they would create a VIE, right? So that VIE didn't belong here. It was owned by the CFO's wife, to say something, or the CFO and his wife. So they would borrow the money here, okay? And then they would invest the money in some sort of venture, okay? And maybe that venture was providing fees here. So this company looked profitable, but this company had a bunch of debt and had an investment in a company that was losing money.
So it's like Shkreli,
Like who?
like Martin Shkreli with Pharma.
I don't know which one that is, but which I don't know that company.
He was part, well, whatever, go ahead.
Whatever. I mean, listen. There's
What would that VIE do?
so, for example, it could borrow money and invest it in a subsidiary. So you'd say, well, why wouldn't they want to have? Well, what they could do is create a subsidiary that would provide some sort of fee income here. This looked very profitable, but now you don't consolidate it, so you neither show the debt nor the losses of this company.
You're just showing fees coming in.
You're just showing profits coming in. Listen, I'm not an expert in Enron, but that's one of the things they would do. I'll give you another one. Enron would enter into a deal with a company over here, okay, that would have some sort of profit associated with it. And then they would create a VIE that would guarantee something to this company. And maybe have to come up with that guarantee at some point. Now you've got an entity you've essentially guaranteed because this company thinks Enron is behind this, right? And it's got the implicit support, the CFO is there, his wife is there, right? But because you're not consolidating, you're not disclosing all the commitments and contingencies that you may have related to a company. Okay?
So it was always someone who was
It was always right.
From
In the case of Enron, it was some sort of officer or related. And when I say the CFO and his wife, they were, because she worked at the company as well. She was a senior like financial officer as well. Those were two of the big players in it. Okay, but basically the accounting literature tells us that what is a VIE. So the accounting literature tells us that the following: a VIE is an entity that does not have sufficient equity at risk. Okay. It is an entity in which the holders of the equity don't have the typical risks and rewards associated, right, with ownership. And it's also an entity where the shareholders don't really have the capacity to absorb the losses that the company may absorb. So, what's the word in Spanish? Testaferro, straw man. It's a bunch of front men that have created a shell company to make things appear a certain way. Okay? Not like a trust. I mean, this wasn't a trust. This was like, this was more, well, it could legally, but a trust is something. A trust is when you set money aside for a purpose. These were companies that were seemingly involved in Enron's business, but whose debt and losses were not being consolidated because of the way that they were being created as VIEs. So Enron never owned an interest in these companies, okay? All right? But maybe at the end of the day, Enron was providing the equity that they needed in order to have some equity here. So make a little loan to here, and would appear as equity, or make a loan to the individuals here who would pump the equity in.
But it wouldn't, like in their accounting books, it wouldn't.
They never.
Wow.
So I go back to, if people would have seen that the substance of this was to take debt and put it outside the books, it would have always been consolidated. So anyway, Enron blew up. There were all these losses and debt that wasn't reflected. So So, FIN 46 came out, financial interpretation number 46 came out. It defined this VIE, right, an entity whose owners, but if it doesn't smell like he's an owner, if he doesn't quack like he's an owner, he's not an owner, okay? Basically says, if a company is somehow involved with a VIE, you must consolidate it. They're like, okay, we don't really care, we don't care. There's a VIE that's tied to you, you consolidate it.
What does FIN stand for? Financial interpretation?
Financial interpretation. So it's a FASB interpretation. So basically the process we need to go through today is the following. Do we own more than 50% of the stock in a company? If the answer is yes, we consolidate it. Do we not own 50%? No. Is it a variable interest entity? Yes. We must consolidate it. Is it not a variable interest entity? Okay. Do we own more than 20%? We got to do the equity interest of accounting. Do we own less than 20%? Well, then we use a cost basis of accounting. Okay? Now,
What if the cost basis was if it's only 20%?
yes. That's why a lot of times you see, because companies don't want to, this is a one-line consolidation, but it's a consolidation. You must recognize the profit and losses, your proportionate profits and losses in a subsidiary. A lot of times you see companies will own 19.9% of the stock of another one. And the reason they do that is they don't want to get into the consolidation. Because not only from here up are you reflecting a proportionate share of income, you also have all kinds of disclosure about your proportionate share of debt. Do you guys remember the Simon supplemental report? They had like their debt to equity or debt to market capitalization ratio. They did it with consolidated subsidiaries and unconsolidated. So you've got to come up with all the disclosure, okay? So, well, let me not jump the gun, but when you are doing equity basis of accounting, you have to disclose in your footnotes what the summary balance sheet and P&L of that entity look like, even though you're not consolidating it, okay? You're not doing a line-by-line consolidation. Okay, so we've identified the sort of three areas.
What are the, if it's an associated VIE,
Yeah.
if you own more than 50%?
Yeah, basically, step number one, you own more than 50%, you consolidate. You don't own 50%, is it a VIE? It's a VIE, you consolidate. It's not a VIE, okay, then you go back, how much do you own? You own more than 20% but less than 50%, equity basis of accounting. You own less than 20%, you do cost basis. Now, you're going to say, what does all that mean? Well, we're not going to go through all the accounting line by line, but. So, consolidation you saw. You add the balance sheet across, you add the P&L across, you create a minority interest line to reduce the profit that doesn't belong to you, and the net assets and liabilities that don't belong to you. Okay? Yes?
You just brought up Simon, and I had a pending question from this morning when we discussed Simon.
Okay.
Is it appropriate to ask it now?
Yeah, that's fine.
All right. Regarding the anchor Macy's, if Macy's get taken out of, say, Daylin,
Okay.
Simon is a Daylin right now. Would Simon be responsible for leasing the space?
It
that
depends on-
Macy
That's,
vacates?
listen, right, so, so what happens is, one of the exposure items that, as I told you, I'm not a retail guy, but one of the exposure items that retail guys have is, a lease is a binding contract, okay, and so the answer specific to your question is that Macy's closes a store that it has leased from Simon, it has 10 years left on the contract, it has an obligation to pay, so they may have a right to sublet it, okay? They may have an early termination provision, okay? But they're on the hook. Now, what happens with retail bankruptcies are, a lot of times you see retailers go into bankruptcy, in particular because one of the things that you can do is cancel lease terms in bankruptcy court. So,
Which chapter?
no,
No, you
13,
wouldn't do
13 is
13
individual.
for-
Oh, the-
Well, seven you're liquidating,
Seven
so,
wouldn't be it either.
No.
Nine.
It's like 15 or something, right?
no, it's in a regular bankruptcy proceeding, corporate bankruptcy proceeding. Chapter 11, chapter 11.
11.
Chapter 11, not 9, chapter 11. In a normal bankruptcy proceeding, one of the contracts that you can sever are leases. And so what retailers will do when they restructure, they'll go into bankruptcy, and there's when the landlord winds up holding the bag. Now Macy's isn't gonna go through that.
No, no.
Okay, so Macy's will, you know, listen, that's one of the things they'll take a big charge, and what they'll likely do is negotiate something. If they don't have early termination provisions with a landlord, listen, if Macy's has 300 stores in Simon, and it goes to Simon and says, we got these 25 and we need to work something out, it's gonna cost them something, but they'll work something out.
And they write that off, because it would be in the current year of business.
Well, right, so
expense.
one of, FASB 5 tells us that a contingency, when it's known and measurable and quantifiable and highly probable, right, or probable, it must be recognized, right? So if it's highly known, if it's probable, right, if it's known, measurable, and probable, it needs to be,
Good word.
recognize it in the current period, okay? Now, so how do we do an equity basis of accounting? We create a balance sheet account called investment in unconsolidated subsidiaries. And essentially, unconsolidated subsidiaries, okay. Investments in unconsolidated subsidiaries, I can't even write anymore, okay. And what this does is it mirrors the proportional share of the underlying net equity of the subsidiary. So Stephen, to your question, to your point, for example, let's say that we've got subsidiary A, or call it B to make it easy. We've got subsidiary B. Subsidiary B has assets of 100, liabilities of 80, and equity of 20. Okay? Parent company A owns 40% of subsidiary B, right? Its investment in unconsolidated subsidiary line in the balance sheet is going to reflect how much? 8. 40% of 20. Year one goes by. This company makes 20. Its equity goes to what now?
40.
Let's assume that it paid off 20 of debt with it, okay? Just for argument's sake, okay? So now equity's 40. What this company does at the end of the year is it makes a journal entry. It debits its investment in balance sheet account, investment in unconsolidated subsidiaries, right? What's their 40% proportion of 20? 8, right? 8, right? And then there's a balance sheet account, and it recognizes in the P&L, there's an account called interests or results of unconsolidated subsidiaries on the P&L of 8, right? Now, what does it have at the balance sheet at the end of the year? It's reflected income of 8, right? And the balance sheet account now is 16, right? What's 40% of 40?
60.
You see how that works? So every year, you're reflecting. You reflect your original investment, right? The original debit, the original journal entry was, just to say something, debit 4 of investments in unconsolidated subs, and credit cash 4. Made a capital contribution of 4. Okay? Next year it has a loss of 20. Say it has a loss of 40, right? Now the equity is what? 0? What's the journal entry the next year?
0.
No, it lost 40, right?
Yeah.
So what's your,
Minus 16.
well, so interests in unconsolidated ventures, minus 40, right? So I've got a loss of 40, right? And I got 16, so I've got a debit of 16, because that's a loss, right? And I credit my investment account. What's my balance sheet going to show now? 0. Okay, so it's a one-line consolidation. So on your income statement and your balance sheet, you're effectively reflecting in one line what the results of operation and your underlying proportionate share of equity is. And then in your footnotes, you're putting summary financial data showing the assets and liabilities and your proportionate share of that subsidiary. The cost basis of accounting is a lot easier, okay?
What basis did we just do?
Equity basis of accounting. The cost basis of accounting is a lot easier. You basically, now, so listen. So this is ARB 51, this is APB 18, okay? This used to be SFAS 14, I'm sorry, 12. That got superseded, it's like 114, 159, blah, 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 blah. Listen, real simple. You reflect your investment at cost, and you gotta do fair value provisions against it every year, okay? That's all you gotta know. And we did fair value, we've done fair value for real estate assets, right? What's fair value? How do we calculate fair value? How do we calculate fair value? Sorry? How do we calculate fair value? Undiscounted future cash flows, right? From that we subtract what? Cost to date, right? What else do we subtract? Estimated cost to complete, right? What else do we subtract? Selling costs, right? If that's greater than 0, do we have a fair value problem? No. Okay, if it's less than 0, what do we have to do? Create an allowance. Create an allowance. I'm losing you guys really quickly.
We're done, man.
What is it?
I'm not gonna lie, man.
What else over here?
From my kid away.
Accounting principles.
It's the total cost.
I lost, cost basis, what was that?
You basically, if you own less than 20%, you're carrying your investment and it's a cost. Subject to a fair value assessment. Now, I just talked about the fair value assessment in real estate, okay? And we're dealing with true strict financial assets, like if you're a bank, then it gets really complicated, and if you guys want, I can show you the article, and we can talk about mark-to-market rules and all that, but we don't need to do that here. We just need to know that we carry our investments, our costs, but like any other balance sheet item, it needs to be subject to a fair value review or evaluation, okay? I will throw a few other things your way. No, we're not done. We have at least another 25 minutes.
No.
Yeah, no, we do. It's still 3:45, but we have material to cover.
The mix starts at 3:45, right? We wanna like network with our fellow students.
No,
You
you
sign on the
want
door that says 3:45 to 5.
you want to drink.
Well, first of all, it's a school-sponsored event, so there's no alcohol. I mean, I just wanna go meet you.
When we're recording our capital contributions, right, like that 4 that I just did, we're basically going to contribute at the cash value, right? What's cash is a cash. For our internal purposes, if we contribute assets or we contribute our time, it's always at our carrying value. Okay? So if we've got land and we contribute land to a venture, our basis is our carrying value, whatever the historical cost is. The venture is going to record it at market. The venture records it at market, but your carrying value always follows your investment, okay? Now, it could get really complicated, but if that contribution, let's say that you owned 100% of a piece of land, and you're contributing to a venture in which you only have 20%, there's an argument that you can make that you could realize 80% of the profit, the part that you don't continue to participate in. So to the extent that there's a culmination of the profit process, you could realize it at that point, okay? Listen, loans made to a venture in proportion to capital are deemed capital contributions. Loans made to venture in proportion to capital are not. So when you consolidate, so I'm a 10% partner, and every time the venture needs money, I give it a 10% loan for purposes of accounting. You're not going to have an investment and a due from subsidiary. It's all going to go into your capital account. Because the assumption there is that that's not really a loan. That's not really a receivable, that's equity that you're putting in. Okay? Now, that's important because in real estate, a lot of times we structure it as loans, but for accounting purposes, those are really investments. Be careful when you are consolidating to make sure that the joint venture or the LLC, whatever the subsidiary is using the same basis of accounting that you're using. So it happens in real estate a lot of times. People will use a cash basis of accounting or a tax basis of accounting, and so you need to somehow convert those financial statements so you can properly consolidate them. Okay? And we won't go into foreign currency translations, but imagine that that subsidiary was in another country. Then we got to worry about how do we translate currencies. But we don't need to worry about that in this class. Okay? But just be aware of it. Other things. Recognition of losses. If you are jointly and severally liable with partners on a joint venture, but you believe that your partner cannot bear the loss, then you must accrue it if there is a foreseen loss. Okay, so we're both partners. We're going to have to start funding losses. We're jointly and severally liable. He can't pay. I'm going to have to cover his bit because we're jointly and severally liable. I need to recognize not only my proportionate share of the loss, but also his proportionate share of the loss.
Is that insurable?
No.
Losses are rarely insurable.
You can get exceptional risk insurance, Claudius.
And he'll sell it to you.
Yeah.
But you must pay for it in bitcoins.
It's probably not worth it.
They do like
Now,
kidnapping.
you typically can
insurance.
insure risks that may lead to losses, but insuring losses,
What about that's a risk?
I thought you sure it's
but that you wouldn't be in business if you.
Need to insure.
Mitigate losses.
Oh, yeah. All right.
No, we got some stuff. Of course not. I'm just looking at what I haven't covered yet, or that we can skip over. Just a couple of things. So, well, we've got a fair value consideration. We've got a fair value concern. If it's an asset that we're going to continue to stay involved in and we're going to continue to develop, then we create an allowance. And I mentioned this before. I'm just repeating this, right? And then the next year we go through the same assessment. So we may increase or decrease the allowance.
It is less than 6.
We create a fair value allowance if the fair value is less than 0. So we create an allowance for what that negative number is. We create an allowance. The next year, we do the same analysis. Market conditions change. Prices go up, costs go down, whatever. I can adjust the allowance. But that's only if the asset is held for productive use. If we determine that we're going to sell the asset's for sale, then it's a permanent loss. So, I'm sorry? You're not going to remember any of this shit? Is that what you said? I'm sorry.
Oops.
But the problem is, as an asset manager, you should know these things because you're gonna be looking at financial statements and you need to
And
understand.
it's funny, because that's not what I said.
So why did he turn all red when I said it? You're redder than your shirt and your tattoo.
It's just funny, because you
Okay.
interpreted that.
Okay, so anyway, if you're gonna sell the asset, it's a permanent loss, and you can never revalue the allowance. Okay, now, the only other thing that what I wanted, I've got a couple of pages of conditions and situations, and I've got.
You keep saying have a couple of things, have a couple of things.
Next turn, sir.
I hear frustration setting in.
It's like two classes in one.
I hear frustration setting in.
Club is personally guaranteed.
So, while this may seem a little bit out of today's, no, that's just trying to make up. That's just trying to make up. Listen, while it may seem a little bit far-fetched because we seemingly are living relatively good times, not too long ago, especially in this industry, we had a lot of turmoil, which really ultimately brought about a tremendous, concern relating to fair value, right? What's the fair value of my investment, right? So when we are dealing with the cost basis, when we're less than 20%, we need to worry about fair value. The reality is when we're doing equity basis or accounting or consolidation, we don't directly worry about the fair value of our investment, but the subsidiary needs to go through a fair value assessment. So we're always concerned about the underlying fair value of our real estate investments. Now, things happened when 2008 hit. We had a lot of sort of ethical issues. We had a lot of going concern issues. We had a lot of fair value issues. So we had a lot of different things sort of rolled into one. We had companies whose value of assets weren't necessarily in line with the market. But we also had a lot of ethical lapses as well. If you remember, at the same time as 2007, 2008, what sort of things came out there? People like Bernie Madoff.
I was gonna say Georgia. It's invaded. I mean, he said what kind of significant stuff?
No,
Sort of like Ukraine being invaded today, right?
Yeah.
Like the build-up in the Crimea. I thought we were going to talk about politics. Okay, so, but we had, what was the guy with the cricket guy in we're going to stay here till I remember his name. The guy with the bank in Antigua.
Oh, yeah, that guy.
Not Davis. Do you remember his name?
No.
Okay. Listen, we had a bunch of ethical lapses because what happens is when things are going well, one, everything floats, and two, people don't do crazy stuff. But when things are going bad, is when people start behaving badly as well. And so situations that are bad tend to be compounded, okay? And so as you can see, Dr. Forgy has not gone to the quarter day yet because he knows we still have 15 more minutes of class. So even though they were all saying you were there, they said,
it takes 2 minutes for him to take down that camera.
no one said that you were chugging beers already. He was afraid you were chugging the whole thing and not going to be any beer left for him. So I pulled this out. There's the Markula Center for Applied Ethics at the University of Santa Clara. I pulled this out this week because I thought it was kind of interesting. So it's kind of like 7 signs of ethical collapse and pressure to maintain numbers, fear and silence. Look at this one: young ones and bigger than life CEOs. That's like the guy from Groupon and stuff, right? Weak board. Which one?
Donald Trump, the regular like CEO, right?
Could be. Weak board of directors. Conflicts of interest that are overlooked or unaddressed. The smartest guys in a room. Innovation like no other company. Theranos, Valiant, right? So you know, unfortunately, things start happening, right? Because, you know, people feel like, I've got to hit my earnings per share target, right? I've got to meet my numbers, okay? I've got to meet my quotas, okay? The ends justify the means. One of the things when we talked about Sarbanes-Oxley before that I didn't talk about, one of the underlying tenets of Sarbanes-Oxley is the whole sort of internal control structure and internal audit process. And when you're going through the whole internal control evaluation, the one sort of key thing that always sticks to me is tone at the top. So one of the things that Sarbanes-Oxley always talks about is, what is the tone at the top? What is the CEO preaching, right? I think I've told you guys, WorldCom blew up. So WorldCom was a big fraud at the end of the day. They were capitalizing all their repairs and maintenance as equipment purchases, okay? They're basically deferring losses. I didn't know that, but I ran a big telecommunications center, and all the WorldCom reps that came, you know, what do you want, a credit card? You want Coke? What do you want? We'll get it to you. It was a company that had really bad karma. It had really bad karma. It came right from the top, you know? It came right from the top. And so, and typically what happens in those places, hey, you've got situations where people feel tremendous pressure to maintain certain lifestyle, keep kids at certain schools, to go to certain parties. What was the guy from ADT? The guy that threw the $20 million birthday party for his wife on the Greek island, you know? Good for him, right? He's in a jumpsuit now, right? You know?
One hell of a party though, I
Yeah.
guess.
Quincy, you were going to say something.
I know it's like, that's the article about disaster, but a lot of those things are a good indication of success too. Like tone from the top, innovation, young and aggressive CEOs.
There you go.
Well,
Airbnb.
It's all, you can flip it either side of the coin. It can also be like
none of. So again, like I'm telling you, is
not the crooked stuff.
no.
Code
But
and
here's the problem. So as I said, you know, the whole backdrop to all of this was that you know, thankfully we're living in what seemingly are good times now, so some of this stuff doesn't flourish. Unfortunately, what happens is when you get the economic slowdown is when all these things that seemingly are very enterprising and very successful, right? So, what was the guy from the cricket guy in Antigua? He was a Texan guy that was selling the phony CDs. Sanford, but what was it? Well, Stanford Financial.
Yeah.
Stanford Financial was great until things started going bad. All these Ponzi schemes. This Theranos was like a brilliant, right, company with all this new technology, right, that, you know, like shortcut all these blood tests or whatever, and it appears to be all a fraud, right? Or some sort of major exaggeration. So, Quincy, I'm not saying that these are always that situation, right? But these are just cautions to say, hey, when things are too good to believe or to, you know, trust, when
Apple's been too good to believe for the last.
no, but I don't think that you've got.
years.
But I don't think you've got the same situation. You don't have the corporate culture that some of these places have. You don't have claims that haven't been backed up there. You know, for example, right? So some of these other things, you know, working in companies, right? Is it legal or is it the right thing to do? How will outsiders view these things, right? You know, is the standard that we're setting for our actions high enough, right? Do we have open communication? That's one of the things, when I worked in a public company, every quarter before the CFO and the CEO signed off on their 10Q, you know, we'd have a meeting. I mean, there must have been, I told you there were 400 people in the company. Well, then we had the railroad, but we'd get about 70 or 80 of us on a conference call, and we'd go through, are we aware of any ethical breaches? Are we aware of any transactions that haven't, and we were all given the financial statements that haven't been disclosed. you know? And so, you know, is there open communication? My boss told me to do this, right? So, whatever, there's a whole bunch of stuff that goes, but perhaps maybe more directly and telling, going back to the fair value concerns, looking at things, is a company having to lay off people, right? Are there fewer people? Fewer people might be indicative of, you know, lesser internal controls, right? Is there excessive pressure on management or on the board of directors, right? Is the personal financial situation of executives at risk? Those might be all indicative of them taking actions, right? Or not taking actions that they should take. Creating allowances, for example, right? You know, have companies been, you know, changing accounting policies or estimated useful lives of assets to exaggerate their, we talked about the quality of profits in one of the classes that we had, right? The adequacy of disclosure, are they disclosing less? What are their sources of liquidity look like? When we talk about financial analysis, when we take a look at debt maturities, what are they faced with, okay? Negative trends, denial of credit, blah, blah, blah. Thankfully, none of these things are that much of a concern right now, but I wanted to throw them out there because all economic cycles come and go, all right? And so we're living relatively good times, but when we're not living good times, you need to be aware that there's, you know, signs out there that can help point out to fair value or valuation concerns or credit concerns within the industry or within companies, okay? So always be aware. And when things seem to be too good to believe, I want to go back to, I gave you the three sort of basic tenets of being an accountant, right? But I left one out, right? When we talked about conservatism, right? And consistency and matching, I left out one, which is we're also professionally skeptical, okay? Okay? So you must always have a healthy bit of professional skepticism when you look at things, okay? Which doesn't mean that you have to be negative, but you have to be skeptical, right? If Bernie Madoff has much higher returns, there was another Bernie Madoff the other day, Platinum Financials. You know, a guy preying on the Jewish community as well again in New York. You know, if the returns look higher than they really, you know, everybody else is achieving, why is that guy always better than the next guy, right? So, anyway, look, with that, we've got 4 minutes. Don't wrap up. Don't wrap up. Don't wrap up. Don't wrap up. We've gone through a tremendous amount of information in this class. I'm going to repeat what I said. Yes, we have. I'm going to repeat what I said in the first class. I would not expect, as it relates to these type of accounting matters, that you either remember or remember whatever when you leave. It's not that you remember, but it's that you're cognizant of facts. So when you look at a financial statement and it says investment in unconsolidated subsidiaries, you go, wow, I know Professor talked about that. That has something to do with consolidations. Now I can do an intelligence search in a textbook, not an Investopedia, okay, about what that is, okay? Or when you're going to enter into a sales transaction, before you think that you can book the profit, pull in your advisor, right? When you're going to make an investment, pull in your advisor. Hey, am I going to have to consolidate it? What sort of disclosure am I going to have, right? So the concepts are what I want you to take with you. As it relates to most of the case studies that we did, they are tools that you will need to use in this industry. Okay? If you want to stay in this industry, you will use them. You will need to forecast. You will need to analyze costs. You will need to understand profits. You will need to understand returns. You will have to do financial analysis. Okay? So hopefully the notes will serve you in the future. I hope you take good things from this class. I encourage you to fill out the online evaluations for the class.
Hey, it was closed.
It closed like a month and a half ago.
Yeah, yours was out there.
I thought that they were going to keep them
Supposedly they were
open
open
till the end of August. Yeah,
until the
because there's
14th.
July
Do we send an email again or no?
When did you do yours?
Early when it first started, like the first email I got.
Yeah,
There's only
mine
one
just
email
said I
that I
didn't
got.
learn anything because it's the first day.
Yeah, it's closed on it.
Well, I thought they were being extended.
They told me to the 14th, but apparently not.
I'll take any feedback, and if you want to give unbiased feedback to the department chair, that would be welcome, okay? So, constructive, you wanna be destructive, don't forward it to me, you know? If it's constructive, I'm happy to try to make this class more valuable, to the next cohort that takes it. With that, I wish you the best of luck. I'm gonna repeat, stay in contact, those of you who are leading the program, stay in contact with the instructors, stay in contact with one another, and stay in contact with those that preceded you and follow you in the program. It's only as good, the experience is only as good as, you know, what you continue to take with you, all right? So what you didn't learn here, what you didn't meet here, the people you didn't meet here, you could still, the contacts, you could still make them if you stay engaged. If you disappear, then it's, you know, it's like if it went away. So with that, thank you for the opportunity. Wednesday you've got a quiz. I'll try to grade them on Thursday, and I'll get the grades out as soon as I can. I know I've got a window anyway. I got a big game Friday, so I don't want to promise that I'm going to do it Friday. I got a big game, probably the biggest game my school's played in 40 years on Friday, and that's #1. But I'll get it up before Saturday, God willing.